This is Don Kaufman, May 27th, 2020, and you are watching the TheoTrade evening video. We're a few minutes after the cash close here on this Wednesday afternoon with the S&P futures up approximately some 38 handles into this close, but I gotta tell you, a wild bifurcation in the overall marketplace with tech stocks just have gone rogue. Let me explain that in a bit more detail. For those of you that do tune in on kind of a day-to-day, week-to-week basis, you're probably relatively familiar with what I'm talking about in terms of this bifurcation. Day in and day out, we've actually seen very recently rotations of capital into or out of financials and into or out of, for instance, what we term the monsters of tech. Now, the monsters of tech, that's a symbol that we built, and that's a conglomerate symbol. It's a Microsoft, it's an Apple, it's a Facebook, it's an Amazon, and it's a Google. Like literally, okay, we built a symbol that, puts together all of your major tech stocks into nice one lump sum. And that's where this wild bifurcation kind of lies. I mean, you got to recognize, the S&Ps today are up some 38 handles, okay, 1.3%. The Nasdaq, though, is, for the most part, massively unchanged. And the big tech stocks, okay, they are, again, have gone kind of rogue, and they're actually down on the trading session. What's really wild about this, and when I talk about, a bifurcation in the marketplace, day in and day out lately, we've seen like 90 stocks up, 10 stocks down. That's in the S&P 100. I mean, there were points today whereby the S&Ps were actually down on the day with a very positive advanced decline line, which is just downright scary because it's displaying the amount of weight that the market obviously has in Microsoft and Apple and Facebook and Amazon and Google and people. Those are the stocks, of course, that were being hit today. So for those of you that follow the advanced decline line on an intraday basis, this is a bit of a cautionary tale because it's not only misleading. I mean, in theory, clearly we could have 90 stocks up and still see a marketplace, okay, that would be down on the trading session. Now, in today's trade, big tech all over the place. Listen, when I'm talking about big tech, this might not look like that much, but I want you to kind of quantify how huge of a move this really was, okay? Big tech, where did it actually go? Well, it started the day at about 9,500, sold off to about 9,250, and then ripped the other direction. For the most part, we just clawed right back to some of the opening range. Now, if I pull up the Nasdaq, maybe the Nasdaq makes a bit more sense to many of you, and that's fine, okay? The Nasdaq, as the kicked off the bell, 9,400, traded all the way down under 9,200 to turn around and rip right back into the opening rotation. Okay, these some wild moves. And again, if you just tuned in, when the day is over, you're like, another humdrum and up day in the marketplace. That could not be further from the truth. We saw wild volatility inside of the Russell, the Nasdaq, the S&Ps, okay? But most of this is consistent and started specifically with nothing more, okay, than the biggest of big tech stocks. And again, that's kind of what we term the monsters of tech. This, you could just watch it in the days to come over here because people, this could be it. Could be kind of a key reversal in here inside of big tech, and that's something we've been looking for. Another aspect that we've been watching and looking for extensively has everything to do with the financials. The financials, once again, ripped today. I mean, you start to think about this, from a broader sense. You're like, well, listen, the financials have been beaten, bludgeoned, okay? If the marketplace is going to continue to the upside, it's got to be done on the back of the financials. And that's an argument that we've been making for the past 2 weeks. By the way, the proof's in the pudding. So we traded it as such, and we used a number of volatility back spreads recently. For those of you that are aware, maybe unaware, I'll back up a little bit here. Okay, what you're looking at right now just happens to be some order history. We placed some volatility back spreads out in the June 12th time frame. Most of those were closed today. We put them on for nothing, closed for approximately a 50-cent credit. Now, a 50-cent credit may not sound like a lot. Come on, people. It's a $24 product. A 50-cent credit after having placed these things for zero up front is an absolute grand slam home run. And, okay, to boot, we actually left a couple of these back spreads on in the June 5th kind of arena. I've got 9 days left. If the XLF continues to appreciate, these back spreads once again are going to explode in terms of profit and loss. So again, if you're looking for it, trade it. These back spreads are working beautifully, just beautifully inside of a marketplace, okay, that is constantly exceeding its expected move. And to reference the point in expected move, what I'm actually saying on that front is a pretty simple, I guess, in context. The expected move, for example, for the next 2 days inside of the XLF happens to be none other than, about 77 cents. And when I say that, we're exceeding the expected move, this XLF expected move, okay, that is based on the option pricing, and the actual price movement in the marketplace is continually exceeding what options are anticipating. So for those of you that do sell options, this is not a good thing if you're selling options. Again, you're selling options, and I'm telling you right now that actual price movement, which is historical volatility, in almost every case, week to week, is exceeding the implied volatility, all right, or better known as expected move. Now, to further this notion of the expected move, let's take you over to the SPX, finishing up some $44.36, okay, in today's trading session. Okay, why does that matter? What does it have anything to do with expected move? Well, for that, I'm actually going to cruise over to the chart. And what I want to display to you, okay, is the weekly expected move. Now, this is something we talk about extensively on every weekend video. We talk about the expected move. And this week, okay, we were actually handicapping right around a $72 expected move. Now, we're looking for $72 higher, $72 lower. Remember, this is going to be a 4-day trading week, so a little bit of a diminished expected move. Nevertheless, where are we right now? Outside the expected move. Now, we're just a hop, skip, and a jump outside of it. But one of the things, again, that I want to reiterate is that the marketplace, the marketplace is literally moving much more than the options would have anticipated. It's not just happening in the XLF. It's not just happening in big tech. It's in the SPX as well. So we've actually ripped through, the upper band of the expected move. And what's critical to understand is, where is that upper band of expected move? Right there at 3,027. Now, from a probability standpoint, I like to discuss a little bit about probabilities in context of the expected move, because that's what expected move really is about. All right, so in context of the expected move, the higher probability trade is always to say that we're going to come back inside of the expected move. Right? Because what? There's approximately a 68.3% chance that we end up inside the expected move by the end of the week. Nevertheless, right when we're on the cusp like this, we still have Thursday and Friday to go. A rip outside of the expected move can be drastic. Very often, and lately, we've seen 2 and even 3 sigma moves. Okay, that's again like 2 and 3 standard deviation moves outside the expected. And you got to think about that. And again, in context of, you're looking for a $72 move, you all of a sudden start talking about 2 times that, and you're like, wait a second, you're looking for like maybe a 140-point move inside of the S&Ps? Why not? Okay, you just hit the edge of the expected move in 2 trading sessions. You got 2 trading sessions to go. Put your helmets on, people. You better have a couple of back spreads ready, because if we do pop to the upside, this one is going to be big. Now, I've talked, repeatedly about what? That we were trapped inside of a range, trapped like a rat in a cage. And we've been talking about trades if we were going to break outside of that range. Here is effectively what we call the volatility box. All right, yesterday, for the first time, we actually cracked outside of the volatility box. Today, it's really definitive. We have closed outside of the volatility box, which lends itself, again, to continued upside momentum, at least in the short term. One of the things I've also discussed is, in my belief, you got to go up to eventually go down, all right, to cave in some of the shorts. So get ready for some wild movement. As I said, I already am positioned for this explosion to the upside in the XLF. And we already hit that one with the back ratio spread. In addition to it, and this is a bit of a unique trade. In addition to it, I've actually got a trade on right now whereby I have purchased an iron condor. And that iron condor, if you take a quick glance over here, that iron condor, there we have the spiders at 303. Here we have what? the iron condor that we purchased, it is now in the money. So this was also designed as a hedge if the marketplace ripped to the upside, and quite ironically, it did rip to the upside. The hedge is on. The iron condor that we bought, we got to close this iron condor. I mean, this thing's only got 2 days left to live, and all of a sudden, okay, at the last minute, starts to go in the money, and we're starting to see degrees of profitability on the iron condor. So we got an iron condor on the dance floor, right? We've got what? The XLF back spread that we've just exited. We've got the SPX, okay, literally crossing through the upper edge of the expected move, and yet at the exact same time, the monsters of tech are defecting on us, okay? All aspects to watch. One last thing that I want to cover, and this is something that I haven't mentioned in quite some time. ES volume. Okay, ultimately the S&P futures. Lately, we've been averaging around 1.5 million contracts. Sure, you can go look at the chart all you want. Today, we actually cracked into the 2 million handle. I'm telling you, this marketplace, it feels different. Okay, we're starting to get, again, a little bit more wild. Volume displays it. Volatility displays it. Everywhere you look, there's signs, okay, of what? Accelerated movement. Again, as I said a moment ago, put your helmet on because it looks like we're going to go through some pretty wild volatility here in just the next couple of trading sessions. Thanks everybody for joining us this evening. Bye-bye.